Welcome back to Vantage. Companies in the UK have just reported there, and we're through March, April. We've got a veteran of the show on. Let's go take a look. Welcome back to Vantage. We have a long-term friend of the show back. We're delighted to have him on again. Welcome to the show, Gervais. Now, normally I get people to introduce themselves, but you have been with me many, many times, so I'm just going to launch straight in. You and Martin Turner have outlined your traffic light stock selection approach in the DIVI annual report. Perhaps go into a little bit more detail as to why you focus on these issues in particular.
Yeah, I mean, the whole point about the diverse income trust is we like to differentiate ourselves versus others, not just in income, but income growth, the ability to grow income over time. The traffic light process, as we call it, is looking to identify companies which don't just have sales growth, sustain margin, and generate the cash, but actually, to some degree, actually manage risk. So we like a management team with real feet on the ground management team. We like a balance sheet which is safe. So if we do get it wrong, hopefully share prices don't go down too far. If they get it right, of course, that's more income growth. And then ultimately, we are very mean in valuations. And so from that point of view, it brings us into, yes, some mainstream companies, and there are some FTSE companies which are on 10% yield, some of the financials, which are growing perfectly well. But there's many others outside the limelight, which perhaps are standing at unusually low valuations where the uplifts are so much more substantial along with the income growth.
Okay, and then bring that to life. So when the traffic lights are all green, talk about a couple of things that have got through the gate effectively and you've added to the portfolio.
Yeah, I mean, so from that point of view, a single red light is a sell. So, for example, earlier this year, we sold BP and Shell, and oil price was coming down. Don't get me wrong, we can't sell every energy company, but we reduced the weightings. Elsewhere, which are coming green, I mean, particularly in the financial sector, we've seen deposit savings actually increasing quite a lot. That's actually helping the banking sectors. The banking sectors are seeing net interest margins expanding. Now, to be honest, we don't get everything right. We sold our Lloyds and our NatWest last year, but we had to buy them back earlier in this year. And specifically, it's not just Lloyds and NatWest. What was interesting is you can go down the market cap range. So we can top up some of our existing holdings. Secure Trust, for example, which is a very small bank. It's only 17 million market cap or 60 million market cap at the beginning of this year. But it was standing on something like a 10% plus yield. It had a valuation of sort of a fraction of that of the mainstream banks. And they did confirm, later on that trading was just fine. And actually the share price has gone up 2 or 3 times since then. So we can do it in the mainstream stocks, but the best opportunities often lie outside of the mainstream stocks, further market cap. And what we've really been doing this year is topping up some of our existing holdings because they just got to such low valuations.
Yeah, I mean, let's build on that. So clearly you find value in things which are overlooked by other investors. I mean, what kind of things do you find are overlooked by other investors?
Well, the main thing is that actually a lot of investors are looking for companies which grow well, which generate cash obviously as they grow, but most particularly, the faster the growth, the better the company. Now that's not a bad way to look at things, but often you have to pay up.
Yeah.
And in a way, we're kind of terribly mean, as I said earlier. So actually, the great advantage about income shares is nearly all of the growth investors say, well, we don't need to include those companies at all. And yet their valuations are often low, not because they're bad companies, but perhaps they've been in an unpopular sector, or perhaps they've been in the UK where there's been local sellers, irrespective of how cheap they are, because they're putting money into the US to participate in the Magnificent Seven. And so many of these companies are actually income stocks, but that's not because they're just slow growers. They're just actually unusually cheap. Sometimes we argue our companies are literally too cheap for people to buy. The market caps are literally too small. People exclude them on that basis. As I say, with Secure Trust, it was down to 60 or 70 million market cap. Nearly all active participants in professional fund management wouldn't invest much below 100 million. But now, of course, as the share price has gone up, and it's gone up to 150 or 200, whatever it is now, and that point of view, suddenly people say, goodness gracious, this is such a cheap stock. And you get this kind of virtuous spiral where valuations rise, but also institutional interest rises simultaneously.
Yeah, no, I like that. And I think, I guess the proof is in the pudding. So you've had a period where, small cap stocks have been out of favour, US exceptionalism, all those reasons, but yet you seem to have maintained a progressive dividend track record. How have you been able to sort of achieve that?
I think compared with a lot of other trusts, we're probably much more wide-ranging. That includes big and small, as we've talked about, but actually in sector terms, we're also braver, perhaps. We invest in mining companies. Gold mining companies have lucked out large in the last 12, 15 months. So actually, some of the best returns have actually been generated by Pan-African Resources, Greatland Gold, those kinds of things. And it's not just that the share price has gone up, but most particularly, say, in Pan-African, the dividend growth has been so much greater than we might have thought otherwise. So actually, by investing across the full range of companies, energy companies, some of the complicated financials, some of the small micro-cap companies, we actually have a greater diversity of holdings, which means that we're in an uncertain time, you can buy them pretty cheaply, and when they turn out to be slightly better than expected or a lot better than expected, sometimes you can get very fortunate and those share prices can really move on.
Okay. The AIC has these sort of different segments effectively when you come and take a look at it. In the AIC UK income sector, how do you, what comes close effectively to DIVI in terms of sort of multi-cap approach? Are you unique, or are there things that you benchmark yourself?
Yeah, I mean, unique's a very strong word. So we like to think we're very different. I mean, if we take most of the mainstream equity income investment trusts, they've done very well, they've generated some income growth's been good over the years, they've been perfectly satisfactory investments, but their portfolios are radically different. They're dominated by a relatively small list of relatively large cap companies in a narrow range of industry sectors. And there's very few which actually have the diversity of diverse income trusts. That's why it's called diverse income trust. Probably the nearest is probably Lowland. Again, it's a good company. It's run by a fund manager, which I highly respect. But more importantly, when you look at the top holdings, they're mainly FTSE 100 companies. Yeah. And that's a massive difference from the diverse income trust. We do have some FTSE companies. BT's been a very good return in one of the top holdings in the trust this year. Yeah. But actually, that's probably the exception. Many of the best returns have been done by other companies which have been more overlooked and where they've come into the limelight and done better.
We get this all the time, the sort of, when we talk to company management teams, the sort of dilemma about, providing a stable income effectively to investors versus, effectively buying back your stock because your valuation is perceived to be cheap, or paying out special dividends. What's your position on that in terms of what is the best way of returning cash to shareholders?
Well, the trouble with a lot of these discussions is people sort of assume where we are now is going to be where we are in the future. Yeah. And absolutely, I don't buy into that particular scenario. Yeah. I think we're into a period of extreme change, not just because I think many of the valuations of the US market have moved so high. Yeah. I think the momentum into the US market is coming to an end. The exceptionalism is coming to an end. I think investors are overcommitted to correlated and stock-specific risk. So I think that's going to lead to capital looking for diversification. But on top of that, of course, we've got Trump injecting uncertainty. And then beyond that, there'll be all sorts of other things which we can't think of, which are going to happen too. So going forward, we would argue that actually this is a moment for companies to be safe. Yeah. So actually, when you come to generating surplus cash, lovely, grow your dividends if you can afford to. But most particularly, don't buy back your shares. Yeah. Actually, don't give special dividends. Actually, at the moment, run the most inefficient balance sheet you can. It may not work because things may just turn out fine, in which case, sort of okay. Yeah. But most particularly, if things turn out to be more unsettled or all sorts of unexpected events happen, companies with strong balance sheets don't just survive. They don't just keep paying their dividends, which is excellent, and raising capital, but most particularly, they can take advantage of the weakness of others. We're expecting a period where actually the strong get stronger and the weak get wiped out. Yeah. So we're saying to companies, I was just in with a PLC last week in a meeting with the chief exec, and they were saying, we're thinking of buying back some more shares, and I said, I wish you wouldn't. I wish you wouldn't, right? And they said, what? And then we said, because actually we just don't know about the future. Yeah. And so actually, I think we're in this period where, in our view, safe balance sheets could be disproportionately advantageous. Yeah, understood. Last time, I think the last time you and I talked was actually just ahead of the sort of budget, and a lot of things sort of came out in that, particularly the sort of national insurance sort of increase. And we've just had the reporting period, the March-April reporting period, so companies out on the road. What are small cap businesses telling you about their sort of current operating environment and how they're sort of navigating this sort of very volatile sort of first quarter with the tariffs and the sort of constant sort of changes? Yeah. Well, the first thing is that obviously national insurance particularly affects those which have large numbers of employees. As it happens, we don't have many portfolio holdings with large numbers of employees. Yeah. So actually, as a starter for 10, we're probably not that affected. Many of our companies aren't that affected. Yeah. Obviously, what they are expecting is change and tariffs and political changes and extra defence spend and extra tax take and all the rest of it. So actually, they are expecting things. But actually, what's been interesting up to now is not many companies have had downgrades. Of course, some have. There's been no profit warning. Yeah. But generally, up to now, it's almost like being a phony war. Yeah. We're expecting things to change. But actually, at the moment, people are doing just fine. And in a way, you could argue that's about the stock market too. US market had a little bit of a wobble. Obviously, had a big dive about a month ago. It's come back up again. And everyone's saying, well, it's just fine. It is just fine. But it doesn't mean it's going to be just fine in the future. Yeah. So I think, if anything, I think people are ready for change, but they haven't seen much of it as yet.
Okay. You do see this sort of pressure on listed companies, and a lot of them sort of now going through the process of delisting, coming off the market. This is the market that you invest in. What's your perspective on the long-term future of a market such as AIM, and particularly in light of some of the sort of tax reductions or the removal of some of the tax advantages that you saw as part of the budget?
Yeah, I mean, it is distressing to see companies delisting. It costs them an awful lot to list. Maybe they can't feel they can raise capital. The valuations are so low, they don't see a future in it. The costs of listing in terms of maintaining the brokers and all the rest of it are costly. So it's a great shame. But actually, in a way, this is what it looks like at the bottom, you know. And we do see in this period of change. What is thrilling is that, you know, for the last few months, and when I last spoke to you, I was talking about the UK starting to outperform international markets. We think people are moving away from, you know, rapid capital growth in the ETFs into income stocks. ETFs in some cases, that's driven FTSE up. FTSE is now outperforming versus global markets, particularly the US, which is great.
Yeah.
Just in the last month or two, we said that we followed on with small caps. And just the last month or two, may not last, small caps are outperforming the FTSE.
Yeah.
Now, if you've got the FTSE outperforming and small caps outperforming FTSE, then basically you're outperforming global markets. So actually, it takes almost nothing in terms of extra capital to keep this trend going. So if you're investing in the largest 90% and you want to invest in small caps, you know, for every pound you take out the large caps, that's worth £9 in small caps, right?
Yeah.
In micro caps, some of the AIM stocks you talk about, right? That's the bottom 2%, excluding the largest 98%. Take money out of the largest 98%, put it in the bottom 2%, that's 49 times the effect, right? Yeah. So we need just almost nothing, and suddenly some of these share prices. And what's been thrilling, not universally, but just around the edges, some share prices have tightened up and started moving. So actually, it doesn't, from zero to hero is actually remarkably close. And I think that's going to happen. And I think AIM companies, fully listed companies, UK quoted companies generally, are going to see this, because the UK is, of course, small versus global markets. We're 4% of global markets. If you want to take money out of the largest 96 and put it into the 4%, ka-ching. Right, and so I think we're actually at this turning point. And I'm not thrilled by what's happening, all these delistings and aims, and things could get worse again. But actually, I think the markets are beginning to find their way through it.
Yeah, no, I'm also encouraged. I mean, I think, you know, I've known you a long time, and you know, people may have forgotten, but there was a time when actually you put a put out effectively to protect your portfolio position. So it's not like you're permanently optimistic, but you have been extremely optimistic about the position of the UK market, and more so, you're on record to say, you know, in the 30 years you've been doing this, you're probably the most optimistic you've been.
Absolutely.
Why?
well, basically, we just see a major pattern change. You know, we got used to this kind of permanent summer of globalization, which is great. You know, all companies succeed. Some succeed dramatically. The failures don't fail. Zombies survive, and that's fine. But the nightmare about that is that actually the really sort of operationally excellent companies don't get enough opportunity to grow, because there's still quite a lot of companies which are sort of in their way. So as you see failures of zombies, you see the opportunity of the strong to succeed in disproportionate scale. So I think that's going to happen. That's very good for fund managers who are selecting stock by stock basis. It's actually very good ultimately for the companies concerned, because they generate skilled employment, they generate more productivity improvement, thereby they can pay wages faster than gas bills go up and all the rest of it. But most particularly it's good for the UK, because actually you get more income coming into the Treasury as a result of tax take. So all of that's very good. But actually what we're looking at now is a period where valuations have fallen to arbitrarily low levels, absurdly low levels. UK's cheap, UK small caps, disgustingly cheap, micro caps in many cases very cheap. And so you've not just got the strong succeeding, but you've got the ability to accelerate earnings growth. You know, what we saw with HSBC when they bought SVB UK, that's a single pound, they put 5 billion on their market cap.
Yeah.
You know, that's good business, right?
Yeah.
So basically, you know, they're 125 billion anyway, 5 billion, extra 3 or 4% growth, nice to have. But as you move down the market cap range to the £1 billion companies, you know, doing not necessarily the same deal, but adding 500 million in an acquisition, albeit you have to put some working capital in, you know, you get 30 or 40% earnings growth. Or you get to microcaps, a £100 million company, which does an acquisition, or a company perhaps generating 80 million, albeit they have to raise some extra capital, but basically like, you get 60 or 80% earnings growth. So what we're going to see, and this is going to catch people out enormously, is actually many of the companies generating surplus cash accelerate earnings growth at a time when many of the global market leaders come under all sorts of pressure because of nationalism. And we think that switch in capital is going to drive crazy amounts of return in the UK market, and particularly some UK small caps.
I sincerely hope you're right. It's always a pleasure to talk to you, Gervais. We look forward to having you back on the cameras in due course and see how the sort of year pans out. But thank you very much for coming on Vantage again.
Thank you very much.